Friday, October 16th. Rates are falling. This is amazing. The definitive long-term interest rate is the 10-year Treasury note. It has fallen now from summertime highs well up in the twos and now crossed this week below 2%. Mortgage rates, vanilla 30-year stuff, well under 4, even 3.75, or close to it. The mechanism is weird. The economy is not anywhere near recession. We're not falling apart, but we're not going anywhere either. The economy is growing in the third quarter. We're now in the fourth. But in July, August, and September, the economy, the GDP, grew at maybe 1%. Consumer spending continued to cook along at about 3%, but that's an artificial number in some respects. We're buying a lot of imported goods that we're not producing ourselves. We're also spending money as consumers in a modest binge on automobiles, which isn't sustainable. Giveaway terms for cars. For a lot of people, a new car is what used to be a new house or a house. We have involuntary spending. Rental properties are scarce in many metropolitan areas, and rents are rising 2, 3, 4 times the rate of income growth. In the Denver metro area in the last 2 years, rents have risen 25%, incomes have grown 6%. Maybe the worst single case in the economy of consumer spending that's involuntary is medical care. We got news this week that, as an example, Medicare Part B will cost about 1/3 of retired people. The cost of Medicare Part B will double next year. Meanwhile, their Social Security checks won't change at all because inflation is so low that there's no cost of living increase. There isn't any sign of inflation. There isn't any sign of overheating in the economy. And the strangest part is that the Fed for the last year has said, hold us back. We need to lift off from zero because we could deal with inflation someday and we'd better deal with it now. Even though we can't see it, we should start now. We could tighten next month. It's going to be this year for sure. And there are a couple of levels in trying to figure out what's up with the Fed. I mean, for most Americans, who cares? It's football season. But in markets and to important parts of the economy, we have to hang on the Fed every day. We have to hang on to it to know what it's going to do. And there's a certain amount of faith, a lot of faith, that the Fed is going to do its job no matter what politicians are up to. And it has a pretty good idea of what it's doing. And this episode of hold me back, hold me back, hold me back, and now nothing is damaging. And it's damaging in particular to Janet Yellen. I don't know of any episode in the last 30 years that is like this one, in which she seems not to know what to do and to be unable to get her colleagues, if nothing else, just to shut up. And now it's embarrassing. The 2 Fed governors close to her this week went into outright rebellion. And Mr. Tarullo and Ms. Brainerd. Ms. Brainerd gave a speech this week that's a really good piece of work. It's easy to find at the Fed. Lael Brainerd. And she and Tarullo basically said, there isn't any reason to raise interest rates this year. Not this month, not next month, and not in December. And there isn't any reason to be in a hurry next year. Not until we have some evidence of need for it. And to have colleagues of hers inside the Fed, not these regional presidents who are hard to control, but to have 2 central people say this is stupid, rates are down from that. And in the compound view of the world, these Fed governors who think that it's dumb to raise interest rates now feel that way because the economy isn't going anywhere. And if the economy's not going anywhere, I'm not particularly optimistic. But the real estate market's the beneficiary. A red-hot place like Colorado stays red-hot. Mortgage rates are less than 0.5% above the 70-year low that they set in 2013. So have a nice weekend.